3 years ago, Raleigh-Durham looked like a can't-miss market, so developers and investors poured money into it at levels never before seen, and now we have some big question marks about what will happen in the next year or two. Welcome to Apartment Market Dynamics from MPF Research. I'm Jay Parsons with your Triangle Update. Back during the recession, 2008-2009, Raleigh-Durham was one of the handful of large apartment markets that didn't take much of a hit. So in 2010, when money began to flow again, Raleigh-Durham was on the short list of markets targeted by investors and developers, many of whom hadn't even considered Raleigh-Durham prior to that. They were, of course, attracted by the great demographics and a stable economy. The problem, though, was that all the developers and investors were seeing the same thing, and so the results were a flood of construction. This is the number that reflects, once all the units scheduled to complete in the next year are built, how much the apartment inventory base will be expanding. Now, a one-year growth rate of around 3% is considered to be aggressive, but you can see that Raleigh-Durham has a number twice that, or more than twice that, 6.4%. The only other market nationally, even in the same stratosphere, is Austin, which was another one of those can't-miss markets back in 2010, and where the outlook is actually more favorable than Raleigh-Durham's due to a stronger economy. Now, that 6.4% growth rate translates to 8,017 units to complete in the next year. Now, for some perspective, in the 2 decades we've been tracking the Triangle area, the biggest 12-month new supply total came in third quarter of 2001, when 6,125 units were built annually. So in the next year, Raleigh-Durham will obliterate its old record by nearly 2,000 units. Complicating matters, the Raleigh-Durham economy is in good shape, but it's not growing at the blistering pace that many investors and developers had anticipated when they greenlighted their projects. And that means that apartment demand and rent growth, while healthy in the past few years, have not been quite as robust as was expected. In the past year, the Triangle added 10,600 jobs. That's down from what we were seeing last year. Still solid numbers, but the takeaway here is that, as you can see from this chart, growth levels aren't anywhere near what we were seeing in the years leading up to the recession, and that was a bit of a disappointment. Now, don't get me wrong, the Raleigh-Durham economy is in good shape, it's healthy, but when you have a record number of new apartments underway, you need to have much better job growth to have a chance of absorbing all of that new product. And that really summarizes the story of the apartment market as well. It's healthy, but it's all about expectations versus reality. Raleigh-Durham had been expected to be among the nation's top performing apartment markets these past few years, and it just hasn't been. Now, when we talk to clients about Raleigh-Durham, we like to joke that it's the top performing, disappointing market in the country. You can see some numbers here to show that. Occupancy is in good shape, 95.4% after a fine showing in Q2, up 50 basis points. Year-over-year occupancy was down 10 basis points. Really good numbers pretty much across the board among submarkets and product segments, with only a few exceptions. And rents showed renewed pop in Q2, like what we saw in many spots across the country. Rents up 2.8% quarter over quarter. Year over year, they're up 3.5%. Now, that's better than the Q1 number of just 2% annual rent growth, but it's still 40 basis points. Still just 40 basis points above the U.S. average, not an elite performance. And that's just a continuation of a pattern we've seen for a while. Over the past 3 years, apartment rents in Raleigh have jumped 11.9%. Now, if you're in the apartment business, 11.9% over 3 years is a very, very good number, but it's only a notch above the U.S. average since we're in the midst of one of the hottest periods in the apartment industry. So that takes us back into a discussion of what's going to happen next year. The problem here is not only are those construction numbers really big, but the construction numbers are big in pretty much all of the key submarkets. The supply numbers just look much bigger than potential absorption capacity. So we do expect occupancy to fall and pretty sharply in the next year, and we think that rent growth will be very limited. But we also think that right now we're hitting a peak at what those construction numbers, and once the supply numbers start to normalize again in 2015, we think this market should bounce back and bounce back pretty well. The long-term outlook appears to be just fine. Those demographics and the economic stability is still there, just as we thought back in 2010. But with all that supply, we're just going to see some short-term growing pains. And that wraps up for the Triangle. So until next time, for Apartment Market Dynamics and MPF Research, I'm Jay Parsons. Thank you for watching.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.